Okay, we're gonna start our lecturing today with work of the financial statements, and most probably you have heard and you have already studied and you have already covered in other courses, but I'm gonna go quickly, so just to make the revision of it. And at the end of this lecture, I will tell you which data you should start actually gathering, then not to lose the time on collection of the data at the end. Okay, you will select any country that you wish to work with and which ratios you should have. You should concentrate more to collect from the financial statements of companies, banks, or any other financial institutions. So we're gonna work with the financial statements today. We'll see the key concept and the skills you will cover in here. You will know how to standardize the financial statements with the purpose to compare their performances. You will know how to compute and interpret some important financial ratios and what are the management tools are used to interpret and to improve these financial ratios. You will know what determinants of the firm's profitability and the growth. So what mostly affects this financial performance of the companies, banks, and any other institutions. And then, of course, you will have some information about the pitfalls and the problems that we face regularly in the financial statements analysis. So there are many main things and main segments of this chapter that we are covering are standardized financial statements, ratio analysis, the DuPont identity, the internal and sustainable growth, and using the financial statement information to analyze the financial position of the company. Talking about the risk management, when we compare the industry, the common size balance sheet, we need to convert something into common. We cannot compare if you compare two different companies in a different countries, you need to make something common. You need to convert it into a common stage where you will be able to compare them in the same level. Like if one company is running in US, the other one is running here, the balance sheets are in terms of dollars and tenge are different. So the numbers will show different, even though the percentages can be the same. So basically, when we convert into the common size, we mean here we compute all accounts that are in balance sheet as a percentage of total assets. The same thing with the income statement. The common size, we compute all items that are listed in the income statement. We take as a percentage of sales. So basically, standardized statements make it easier to compare the financial information, specifically when the company grows. So they are all useful for comparing the companies in different size if they're same industry. Ratio analysis, the ratios that allows you for better comparison through the time or between the companies, cross or through the time series. As we look into each ratio, you can ask yourself what ratio is trying to measure, and you could get some information with a comparison. Okay, everything is compared actually to something. There should be always a benchmark. You cannot just give a certain decision on certain ratios. Let's say some ratios given some numbers, but this number doesn't tell you immediately something. It's up to the comparison. You need to compare with the benchmark, with the industry average, with the competitor, and so on, in order to come up with a certain conclusion about the financial position, about the risk management position it takes, and so on. Ratios are used both internally and externally. There are some categories of the financial ratios which are very popular around the globe, and actually there are thousands of ratios, but they are categorized into 5 categories in here: short-term solvency ratio, liquidity ratio. Mainly they're meaning the same. It measures how the companies will be able to generate enough cash to just cover the short-term obligations. If there is a problem, that will really affect the banks or institutions uh, negatively. The example, you can get it from the global financial crisis that took place in 2007, 2009. Still, the financial institution trying to be recovered from that. So while recovering from that, the pandemic gives the hits on the other side. So the main problem of the global financial crisis that took place around the globe was the liquidity issue. All the financial institutions, they didn't have enough money to just meet the short-term obligations. And you know that what financial institution does and how they do their businesses, they just basically collect the deposits. I mean, mainly talking about the banks, the commercial banks. They mainly accept the deposits and lends as a loans, and the difference, the interest rate they're charging and giving for loans is what the profit they're making from actually. So this is the mainly profit. However, if they face some short-term liquidity, like from the depositor sides, so they have to be ready at any time to meet the demands of the withdrawals. So anytime you can go and withdraw the money as a depositor. However, if the bank face some problems, like they cannot just meet the demands, for example, in Kazakhstan, we have if you compare to the Turkey, you cannot go and withdraw the money any amount you want it. Let's say you want 5 million tenge now, you cannot go and withdraw this amount. So you have to call, you have to make the arrangement in certain day, and then you can withdraw. Like in Cyprus, in Turkey, you can go at any time and withdraw any amount of the money that is belong to you. But any amount, of course, there's some certain limit. You cannot withdraw $100 million or something like this. But if you compare the amount of the money which can be withdrawn in Kazakhstan with what the amount money can be withdrawn in Turkey and Cyprus, is totally different. And of course, increasing the number of the withdrawals puts the banks into danger. Okay, somehow this is really a big risk for the bank to face the liquidity problem. If the financial institution cannot predict how much money will be withdrawn during this month or during this week or during this days, then the bank will have some issues with the liquidity position. So the bank should be always trying to guess what determines the liquidity. Okay. And one question I might ask you guys, for the bank to be stable, what the bank should do then? To keep a lot of money in the hands? To be liquid?
Not necessarily, maybe.
So imagine the banks keeping the money to be the liquid, to be the stable, in order not to face this liquidity problem. What could this action cause as a consequences later? What could be the consequences? How it will be affected then if they keep a lot of money in hand just to be stable and liquid?
No returns.
Very
And
good.
they cannot repay deposit percentage, interest on deposits.
No, Alma, they actually can repay it, but Alnur is really underlined very good point in here. The return will be small because what happens, whatever money you receive, let's say 50 billion you receive from the depositors and 50 billion simply to say you should give it as a loan. This is deposit, this is loan. However, in order to be stable, you should keep some money in hand to be liquid. Otherwise, if you face some liquidity problem, if depositors come and tells, I want to withdraw my money, then you should, what do you call it, be in advance ready to that withdrawal. If these depositors comes and withdraw all of the money at the sudden, you will face a liquidity problem because you have lent already. So what the banks they do, they call a required reserve. Have you heard about it? Definitely you should have heard it. So they keep some part of this money. So they collect the deposits of 50. However, they do not lend of this collected amount as 100%. Maybe they could just rent it 90% what money they collected, and 10% will be kept as required reserve, just in case of if any depositor has decided to come and withdraw the money. So this required reserve came into existence as a consequence of liquidity problem. However, if the bank decides to increase this required reserve to more than 10%, what happens? Basically, it reduced the potential profit, because if they keep more money in the bank, they will have a less opportunity to earn on loans because they will lend less money. So we can see there is a theory is developed. Liquidity management is inversely related to the profitability management. Okay, we have two different departments now. We have on one side is liquidity management department, on the other side the profitability management. So liquidity management department says, look guys, we need to be very stable during the pandemic. The people, they need the money, they need to earn, they need to withdraw so that we don't face any liquidity. So the liquidity management tries to pull the sheet on themselves. However, the profitability management department says, look guys, if you take this liquidity position, if you increase the required reserve, then it means the performance of the bank will go down. However, does it work in real market in this way or not? We have to investigate. Is it the same position of the liquidity management takes in Kazakhstan? We can investigate, taking on one side the liquidity management investigation and trying to see what factors affect the liquidity management in Kazakhstan. Let's say there are some factors like capital adequacy, the other ratios, the other variables that may affect, and try to see what are these effects, positive or negative. In Kazakhstan, in order to improve the liquidity management, improve the liquidity, what should be done? Or vice versa, improve the financial performance. Should you reduce the liquidity or increase the liquidity of the company? In theory, yes, you should. However, when it comes to the practice, in a real market, it could tell you a different story. So that's why you are here as a risk managers, to find a certain solution. What could be done to solve this issue, the liquidity problem, so that the bank, they don't have it, because the main problem of the liquidity of the banks or the financial institution is the liquidity. If the bank does not solve the liquidity, believe me, this liquidity issue, if it continues like from one period to another period, it will end up with the long-term solvency issue, which is more severe. That long-term solvency means a bankruptcy. The banks will go bankrupt. So you need to be very careful as a head of any division. When you take the decision, you should take into consideration any ratio or any aspect that can affect your decision, because your decision is interconnected within the company. So all the departments will be affected actually. So we are given here sample balance sheets. In next slide. So on one side we have assets, on the other side we have liabilities and equity. I will not explain it because you have already taken the accounting courses. You know very well this balance sheet. I don't have to spend the time on it, like what is the cash and so. So this is the mainly basic principle of the accounting, where the asset is equal liability plus owner's equity. However, the representation of balance sheet, or mainly the financial statements of the companies, either it's a manufacturer, either it's a financial institution, is changing from country to country. Like US has one representation method, Europe has got another one, like GAAP, General Accepted Accounting Principles, which is mainly treated in US, and IFRS. Have you heard about it? Like IFRS and GAAP?
Yes.
Yes, of course.
Yes.
So mainly, the difference between the GAAP and the IFRS, it is believed that by, according to some scholars, that saying IFRS is more flexible, is more, it is easier to use it. It is easier to represent it. But in a GAAP system, it really makes the thing complicated. Like it's very strict and bit complicated in contrast to IFRS. So in 2016, US actually SEC, Security Exchange Commission organization, they have decided to move from GAAP to IFRS. There are around like more than 3,000 companies actually there, which is publicly traded. They want to move to IFRS system, but still they are working on that. They started in 2015, 2016. Income statement basically is here. What we know here, that all revenues minus all the expenses will generate earnings before interest and tax. Then you subtract the interest, then you subtract the tax, you generate the net income. And then the net income, whatever is left, okay, some money will go to the shareholders as dividends. And whatever is left after the payment of the shareholder, that will be retained in the company, which is called in the balance sheet additional to retain earnings, which is in the equity side. Okay, net income basically divided into two parts: retained earnings, the money that we retain in the company, and dividends that will be paid to the shareholders. So we have some ratios in here. They're straightforward. I'm pretty sure that you have already seen these ratios, like current ratio, quick ratio, and cash ratio. These three ratios, they measure the liquidity position of the bank or financial institution or any other companies, okay? In theory, it is believed that for the company to be liquid, I mean, to have enough money to meet the short-term obligations, the ratio should be more than 1. Like current ratio, it includes all the current assets divided by the current liabilities. If you come back, so current assets are here, total current assets, 2,447,000, divided by the total current liability by 1,968,000. So if it is more than 1, then it's considered to be liquid. Quick ratio is showing more realistic picture. It says, because look, the current ratio could tell you that it is liquid. However, in a manufacturing company, if you compare to financial institution, manufacturing company has got more actual warehouses, more inventory, because they need to resell it, they need to buy it. So the conversion into cash, it takes a bit longer in a manufacturing company than in financial institution or any software companies. Take the airline industries like Boeing and HSBC Bank. comparing the liquidity, it will be very difficult to you, because if one has got like 1.5, the other one has got 1.8, it doesn't mean that the financial institution company HSBC is more liquid than manufacturer company Boeing, airline industry. So everything is matter in terms of comparison in the industry. Actually, it's better to compare within the industry rather than just across industries. So the quick ratio, it shows you the more realistic picture. It says, let's just exclude the inventory, because inventory could pull down the, actually could just exaggerate the liquidity ratio. However, if you just take it out, you could just see a more realistic picture. So you will be left with more easily converted assets into cash. So quick ratio, this is what it measures. And there's another ratio, which is cash ratio. It says it's more, the most realistic liquidity ratio, that is only taking only ready cash, which is in hand, divided by current liability. So as we can see, as we go from up to down, the ratio is going down. However, if you think that the inventory is not the big matter, and you can prove it by using another measures that measures the inventory, like turnover inventory ratios, like that we have it in hand, then you could just easily use the current ratio. You say there is no need to just exclude. But however, if you lack the information in terms of how the inventory is being managed and how frequently they are utilizing their asset, their warehouses, how frequently they are reselling and getting the cash, then you could just easily come up with a conclusion saying that, yes, there is no need for the inventory to be excluded. I just can use current ratio as normal ratio, as a liquidity ratio, to just measure the liquidity position of the certain company and to compare with the industry, of course, or to compare with the competitors. So having just 1.24, it necessarily doesn't tell you directly, okay, this company is highly liquid. However, it is liquid, yes, it can generate some cash to pay the short-term obligation, but if you compare with the industry, if you compare with the competitors, it could tell you a different story, actually. We have a computing leverage ratios. Leveraging means just borrowing. Leveraging ratio shown whether the company borrowed money or to finance their assets or not. The higher the leverage, let me ask you in this way. Okay. If company has leverage 70%, which means that they borrowed, like their total asset is 100%, which is financed by 70% by debt and only 30% by equity. And if the leverage is 25%, is another company, and let's name it as A and B. So company A borrows money to finance their asset, almost 70% of their assets, and company B only 25%. Who could tell me, give some information, like up to today? So you have studied, you have taken many finance courses, corporate finance, principles of finance, and so you've got enough information, you've got enough knowledge to come up with a certain conclusion. What do you think about the company A, and what do you think about the company B? In terms of
Well,
riskness, in terms of future prospects?
Well, I think it usually depends on the industry standards, right, with the leverage ratio. But right away, I can say that the company A will have higher return on equity on profitable years, because higher leverage will like multiply or increase the whatever profits or loss you have. So I would say company A would be, generally speaking, riskier because it multiplies whatever you have.
Very true. Very true. I totally agree with you. And what the first thing that you have just mentioned is the industry. It depends on the industry, whether it's a manufacturing industry or if it's a financial based industry. And we know from the financial conventional financial-based industries, they mainly borrow the money to amplify their profit to return. I agree with you. Very good. So if it's financial institution, they borrow more money to make more money. So the return, the future prospects is good for the A rather than B. However, A is considered to be riskier as well than B because more than half of the assets is financed by debt. If something goes wrong, it will trigger a really big financial problem in the company, actually. So another thing that you could have underlined here is there is a good future perspectives in terms of getting high return. Additional to this, I could add that when the financial institution or lenders or creditors who provide the loan, if they provided to company this much loan, it means this company has got something. They have investigated, they have seen all the pitfalls of the company, and they have provided the loan. So the creditors, they trust this company. So it's a good information for us that there's a future perspective. Maybe this company borrowed a lot of money, so we need to check the asset side. What have been bought and what have been done with this money? Maybe actually, if you see if the company borrows the money, let's say in an industry which is manufacturally based, that are producing something like tangible assets, then we could expect that this company is acquiring another company, or there is some mergers is going. Merger and acquisition activity could take the place. So we need to check up the asset side, what's going on. There's some coverage ratios that shows how long and how fast they would be able to cover only the interest. And this coverage ratios is purely coming from the income statement, like time interest earned and cash coverage, so on. And we'll have some activities. We'll use these formulas to solve it, okay? But the mainly, why I am giving this to you, I want you to concentrate on the ratios while you will be downloading the data to download a certain ratios. And I have to be sure that you know all the ratios that we're gonna use in our project. There are some inventory ratios that, as I told you, that where you should look at it as a financial analysis, like inventory turnover and days sale in the turnover in inventory, how many days it takes to just turn over your inventory, and how frequently you turn over your inventory within a year. Apart from that, we have a receivables, like a goods and services that have been sold on a credit basis, and that we are planning to receive it, the money, like turnover in the receivable and days in terms of sales, how long it takes for you to receive the money. There's a general one, which is total asset turnover. It measures actually how efficiently you're using your asset. And it's not something extraordinary when the total asset turnover becomes less than one, especially if the firm has got the large amount of the fixed assets, so it's a normal thing. So you cannot make any conclusion based only just by calculating the total asset turnover, how efficiently they have been using their asset. In order to do that, again, you have to compare. Everything is the matter of the comparison. Computing the profitability measures, there are like some very popular profitability measures: profit margin, return on assets, return on equity. And for the financial institution, it is very popular to use net interest margin, like profit solely generated from earning the interest. While you're here, I would like to take the attendance. Okay, Addn is here. Lee.
I'm here.
Okay, Evgenia.
I'm here.
Alnor here. Almat here.
I am here.
Arina. Sakin here. Anwar.
Yes, I'm here.
Dinara.
I'm here.
Dana.
I'm here.
Temirlan.
I'm here, Professor.
Okay, Jean.
I'm here, Professor.
Okay, great. Let's continue. So there are some ratios which has been, okay, let me talk a bit more about the profitability measures, okay. So in here, we'll concentrate more on return on asset and return on equity. Plus, if you're dealing with the financial, it's actually, these ratios, they measuring the financial performance, okay. The main idea and the main purpose of establishing any company is to earn the profit, okay. So the higher the profitability, the better you are actually. So coming to the market value measures, we've got market price, shares outstanding, price earning ratio, and market to book ratio. So these ratios are provided as well. You are expected that you know these ratios. I'm not going to dip in this through this ratio, so we'll have some. And this is the summary of the ratios that has been divided into 5 categories, like short-term solvency, long-term solvency, asset utilization. And so the mostly that we're going to deal with the risks is the first and second one, okay? This. Like credit risk and liquidity risk. This is what we're going to deal. And sometimes we might be dealing with financial performance, okay? So in the project that you're going to deal with is with these ratios. So another point to measure the profitability, the asset management, and the leverage at the same time with one formula, we are given some DuPont identity. Have you heard about it?
Yes.
Yes.
Okay,
Yes.
then I don't have to explain it very deeply here. So DuPont identity, we are given to use it to measure, if you want to at the same time measure the profitability and leverage and the management of the assets. So we can do it through the DuPont identity. So profit margin is the measuring the firm's operating efficiency. How well does it control its internal costs? Total asset turnover, it measures the firm's assets, how efficient it has been used. And equity multiplier, it measures the financial leverage of the company, the credit riskness. And as I told you, while I just stopped on the income statement, there's a payout and retention ratio. So dividend payout ratio is how much money you will pay as a proportion to net income. As we said, that the net income is divided into two parts, which is dividend to shareholders and additional to retained earnings. So the money that you pay to the shareholders and whatever is left, like that amount will be retained in the company, which is retention ratio, okay, 1 minus D. That additional to retained earnings divided to net income, or earnings price per share minus dividend per share and divided by EPS, it will give you actually the proportion of the retention ratio. Or we can make it like 1 minus dividend payout ratio. Like if your dividend payout ratio, how much money you pay to the shareholders is 30%, that means the remaining part will be kept in the company, will be retained in the company, which is retention ratio, which is 70%. So coming to the growth rates, we have internal growth rate that tells us how much firm can grow their assets using some retained earnings as the only source of financing. And sustainable growth rate, it's another measure of the growth that measures how the company can grow their assets using internally generated funds and issuing the debt to maintain a constant debt ratio. So the debt ratio should not be changing. That will help you to measure by how much your company's asset will grow by using your internally generated funds. So determinants of the growth rates are basically profit margin that measures the operational efficiency, the total asset turnover, the asset use efficiency, financial leverage, choice of optimal leverage, and of course the dividend policy, choice of how much to pay to shareholders versus how much money should be kept in the firm to reinvest that amount. So these are factors, these are the variables that affect the growth of the company. So why we evaluate the financial statements? For the first reason, for internal use, like to evaluate the performance, we need to see how it could be managed properly. If you do not evaluate the financial statements, you will never know where your profit comes, okay? You know, I have a friend, he has like a group of companies in here, and he was looking for a financial manager last year, just right after the pandemic, like it was in the May or June, I don't remember exactly. We had we met with him, and I suggested one of my students. He was taken, and now he's working there as a financial manager, like he's managing the money in the company. The problem that my friend actually faced is he could not manage their money. He did not know where the money comes from, actually, mostly. He had many companies, and he had to decide which company's aspect or which part of the company, especially what was giving more money. He had to evaluate internally what factors affect the profitability mostly, so that he could just pay attention more to that part and increase the profitability. One thing he said, in the marketing department, I'm using several instruments to attract the customers. But myself, he said, I don't know from where mostly customers are coming from. I'm using the internet. In the internet, it has been divided into several parts: Facebook, Instagram. He said another advertising, sponsorship, and so on. Apart from that, he was using the physical billboards. He was using the elevator billboards. The billboards which was installed outside. When you go through the road, across the road, you can see the billboards of ads. And he was saying the customers are coming, but nobody is analyzing from where most of the customers are coming and buying my products. So he need that evaluation of the financial statements, especially in terms of the money that has been spent. In, for example, he has spent all the money proportionally. Okay, he has spent all the money proportionally. Like, let's say this is internet, physical billboards, and elevator billboards. Okay, so the three sources. Okay, he was spending all the money, let's say 40% here, 30% here, and 30% here. The budget was dedicated in this way. But if he just made some analysis and he could come up saying that internet marketing was given 90% of the customers. So if this is so, do you think that would it be this proportional distribution rational? If 90% is coming from the internet, then what he should do, he just redistribute the money, the budget accordingly. It's just one example. Like there are many examples, like maybe some departments were demanding a lot of money, the money that they don't need it. However, they just required and for unnecessary things. So everything should be controlled. Everything should be evaluated, and all the financial statements should be checked. Maybe you acquired some asset that you're not using it, or you have a liquidity problem, but what triggers this liquidity problem? What is the main problem? I mean, what caused this liquidity issue? Why you don't have, and he said the main, one of the another problem that he had is when the time comes to pay the debts, when the time comes to pay the creditors, suppliers, he doesn't have the money. However, he has a lot of products sold and he made a really good profit in the income statement. But in terms of the cash, he doesn't have in hand. So what could be checked in your opinion in order to find the problem in that company to meet the short-term obligations? What would you suggest if you are, let's say, now you are being interviewed and you are asked, or if you are working as a financial manager there and you are asked, please find out that problem where my money goes to, or why I'm selling, my net income is positive, is very high in contrast to last year's. However, still I don't have the money to pay the creditors in this month, to pay the suppliers. What could be the problem in your opinion?
Maybe the receivables period, right? I mean, how fast he can get the cash from his customers. That's the one point. And another point is that he might extend the days he repaying his accounts payable, right, to his suppliers. So that will increase a little bit his cash flow, and especially cash inflow. Just one idea.
That's very true, Alnor. Actually, what you said is very correct. First of all, he has to check receivables, then payables. So, it doesn't work like this. Whatever you sold, you just put the dates, any date you put it, and to receive the money. No, you have to forecast. You have to control everything. You have to see whether in the same day you don't have any payments when you don't receive the money. So you have to somehow control payables with the receivables at the same time. So to match it and to make motivation to the suppliers. How could you make the motivation to suppliers to pay, for the receivables, to make the motivation for you to receive more money?
They usually do like 1% discount within 10 days or something like this.
Yeah, that's very true. Give the discount. If you pay earlier within these 10 days, you will get discount 10% or 5%. This is how it works. So there's some should be. So This should be done by the financial manager who is working to manage in order to basically what you're doing here, you're trying to manage the risk. And the risk is not just in terms of it's all, there are many different types of risk: liquidity risk, credit risk, paying risk, and there are many. Okay. Ratios are not very helpful by themselves. We already told this, and they need to be always compared with something by the benchmark. There are some other analysis took the place. Time trend analysis used to see how the firm performs using the throughout the time. Okay, you're trying to measure like from 2000 to 2015. Within 15 years, how the performance has changed, how the profitability has changed, how the receivable turnover change or inventory turnover change, or making the peer group analysis compares to similar companies within the same industry. Okay, using the same standardized common size and balance sheet, even they could be in a different country, however they're in the same industry. The ratios are figured using the financial data. They are reported from annual report from Home Depot in 2004. So there's some benchmark are given like for industry. Okay, once we calculate our ratio 1.4, but the industry is 1.8, we cannot say that our company is liquid. According to the industry, our company is not liquid. However, we know that in theory that it says that if the liquidity ratio is more than 1, it is considered to be liquid. Or the quick ratio, as you can see it. The long-term solvency ratio, industry is totally different if you compare. So everything is matter of, is the subject to comparison. We have asset management ratios like inventory turnover 4.9 and industry 4.2. So inventory is really good. Receivable turnover 59, like every 6 days, but industry is 21 every 17 days. So receivables and inventory turnover is pretty good actually. Total asset turnover is 1.9, industry 2.8. So as we can see, total asset turnover is not really performing well in contrast to the industry. And profitability ratio, you can compare. Profit margin before the tax is 10%, but industry is only 3. Return on assets 19, and industry is 7. Return on equity is 34, and industry 16. So this is on average. So I will show, in order to, actually, you cannot say the certain, this is industry for certain companies, okay? For the financial institution, it could be different. When you collect the data, let's say from the World Bank database, it could be a different story. You can collect all the data because they use, let's say I'm collecting net interest margin, and I can take the average of it. That could give me the actually industry number, and I could see what is the, for Kazakhstan, specifically for certain bank, what is the average for certain. So in this way, you could just easily compare and easily get the industry averages. So here, I want you do the following. Select any country. So for the next time, next class we meet, I want you to select country. And you should select in that country the companies. You should select 10 companies. If you select banks, it should be 10 banks. If you select the petroleum industry, you should select at least, if there are, let's say, 6 petroleum companies, then select 6. You could say, but if there are like 20, select at least 10. Okay, find the country and select the companies, the industry. If it's a manufacturing, if it's a software, if it's a financial industry, and so on. Collect them, and I want you to work out with the financial statements. I will put on the Moodle the ratios that you need to collect by the next Wednesday. Apart from
Professor?
that, yes, please.
So there is no need to the market capitalization, yes? Or the size of the firm?
Actually, you know, I will put all the variables in here. This size the firm, it has not been mentioned, and the market capitalization has not been mentioned in here, but it is very urgent. The market capitalization, actually, it measures the financial market development industry in the economy. So mainly some practitioners and some scholars, what they do, they are trying to see how the market capitalization affect the liquidity. I mean, how the development of the financial market affects the liquidity management in that country, or the banks or the companies and so on. So you will manage two risk, liquidity or credit risk management. So one of it. But now I want you, before Wednesday that we meet, you should find either one country and which industry you're going to work. So with this, you should come up and share with me. I will take a note and we will proceed in this way. So before Wednesday, I will prepare which ratios you should work with and which ratio you should collect.
Excuse me, should we use the data for the 2020, right? Or
up to date, yes. Whatever you could be able to get it, it's good. But preferably, I want to get it 2020. Why? Because I want to measure the pandemic effect as well. How the pandemic affected the liquidity or credit risk management.
okay, thank you.
Professor, I have one more question.
Yes, please.
So it's an individual assignment, yes?
Yeah, it will be individual. You can make it in a group. If you have a peer, you can find one person to you. You can work together. But if you prefer to do it alone, you can do it alone.
Okay,
But
got it.
this work, this scientific work, will be sent to the publication, to the conference that I have shared last time with you.
Professor,
Yes.
you said that we can do it in group. Is it also like one country, one industry, and 10 companies?
Yeah, yeah,
Or group, yes? Okay.
yes. You can select several countries. You can select 2 countries, 3 countries, or one group of classified countries like Eurasian Economic Custom Union countries. Like there are 5 countries: Belarus, Kazakhstan, Kyrgyzstan, Azerbaijan, and Russia. It could be a very hot topic as well. A very interesting topic and investigation for yourself. It's up to you. You can make with a group of classification. You just come up with some, you say, I'm going to work with this country, and this is the industry that I'm going to work, petroleum industry, and so on. And by Wednesday, I will put some ratios. I will tell you this is ratio that you need to work out. So you should start collecting the data. And then meanwhile, while we are getting through the other subjects, I will teach you how to use some software program to run the regression analysis, especially Stata. Some of you already know because you have taken Islamic banking from me, like Alnur, the only person I think. But anyway, but I will teach it again, like step by step. Do you have any questions?
Yes, Professor, should it be done by this Wednesday or next Wednesday?
This Wednesday.
Okay.
You should
thank
select one country and industry that you're going to work with.
But ratios should be calculated by next week.
No. Wait, ratios might be, it might take you a lot of time for you to calculate. There will not be a certain deadline for the ratios. Don't worry about it. I will give you enough time to get it because it really takes the time to collect this data. I know it. And some of you have got some other stuff which is deadline putting the pressure on you. I know it as well. I'll take this into consideration. But for this Wednesday, I want from you to select the country and industry.
And
Okay.
that's all. Only
So
country
by
and industry. And
Yeah,
from this
country and industry. Yes, country and industry.
companies, right?
Yeah, no, the companies is another stage, but which industry are you going to work? Definitely when you see the industry, you will see what companies are available there.
Okay.
with this Wednesday only country and industries.
Yes.
Excuse me, Nursan, should we order the countries so that our countries wouldn't be coincide with each other, right?
Yes, you can share with you. You have a WhatsApp group, yes?
Yes, yeah, we have.
Okay, share in the WhatsApp group. It could be possible that somebody has got the same country, but make sure that you're not in the same industry.
Okay, yeah, got it.
Okay, country could be the same. There's no problem. But industry is not acceptable. Okay. You have any other questions? We have 15 minutes left. I want to give you something else as well to do it. If you don't have any questions.
Yes, sir.
Yes.
Should we submit it on Moodle or we will do it on
No. You're gonna share with me. We're gonna discuss it, and then
During the class, yes.
during the class, I'll give like 10 minutes for discussion, and try to see anything can be changed or not. We'll see it. Okay. Now. Okay. I want you to answer these two questions. Just take a picture. I will arrange the activity. It will be considered as an activity. Answer it on the Moodle. Okay. I'll put it on Moodle. Activity 2. Deadline is 18. And we start at 14 and finish it at 14:20. And it should be online. Just type your answer there. Not more than 200 words. Activity 2, you enter it and try to answer these questions. Okay, the questions are here. Once you finish, you can leave the conference. Thank you so much. See you on Wednesday.
Okay.
See you.
Thank
Answer
you.
it with your own words, okay? Try to answer it with your words, whatever you remember.